Hey there guys, welcome back to my second video, which is going to be on the NCEA Accounting Standard 2.4, which is based around interpreting financial information. So let's just get straight into it. So first of all, we're just going to look at what areas are actually covered in the standard. So there are four main areas covered: profitability, liquidity, financial stability, and management effectiveness. And for each of these kind of areas, what we need to be able to do is we need to be able to calculate them, explain the meaning, explain the trends and consequences, and provide recommendations to the business. In this video, I'm going to take you guys through all of the concepts that you need to understand, and I'd really recommend at the end of each concept pausing the video, taking down some notes, and then going on to the next concept, and you can break it up over a few periods of time if you'd like. In a later video, we're going to take the stuff from the basics that we're working on now, and we're going to apply it through to an exam walkthrough, looking at achieved merit and excellence. But yeah, apart from that, let's get into it. So starting off with just looking at what the formula sheet you're going to get in the exam. It takes you through all of the formulas, and you'll be given this in the exam, so you don't need to memorize these, but it is good to have a strong understanding in the case that they do ask you to calculate any of the formulas. So we'll start off with markup percentage. So markup percent measures how much you increase your costs to set your selling price. So the formula is gross profit divided by cost of goods sold times 100. So for example, if gross profit is $50 and the cost of goods sold is $100, markup percent is 50%. Markup is 50%. And in an exam, you might evaluate trends. So say, for example, if the markup percentage increased from 50% to 60%, this could indicate a higher margin due to cheaper costs for the business, such as maybe switching to selling secondhand goods. You could advise the company to consider offering more secondhand items if they're profitable, or review whether competitors' prices would allow them to increase the price and therefore increase the markup percent. So that's starting off pretty straightforward. The next one is gross profit percent. So gross profit percent shows how efficiently production costs are managed. So the formula is gross profit divided by sales times 100. So if gross profit was $30 and sales were $100, the gross profit would be 30%. Gross profit would be 30%. In the exam, you might need to explain a rise in gross profit percent due to lower cost prices from suppliers. You could recommend to the business to maybe negotiate a better deal with the supplier, or find another way to cut cost of goods sold to increase your gross profit, and therefore increase your gross profit percentage. Moving on to the next one, which is meaning of net profit, or profit for the year percentage. So this is the kind of profitability metric that most businesses will look at. So the formula is profit for the year divided by sales times 100. So if your net profit was $39,300 and the sales were $480,000, the net profit percent would be 8.2%. If this has improved, it could reflect maybe cost-saving initiatives such as decreasing expenses, or it could indicate that sales have increased. So you'd want to suggest to the business to continue monitoring these things, and to increase net profit percent, you would need to increase sales while expenses remained relatively constant, or cut expenses. So moving on to the next one is administrative expenses. So this ratio shows how much of sales revenue is consumed by administrative costs. And just for those of you who don't know, administrative costs are costs that are not directly associated with finance or with delivering the goods. So this would include stuff like accountancy fees, office supplies, office electricity, stuff like that. So an example for this would be if administrative expenses are $20,000 and sales are $500,000, the percentage would be 5%. If this ratio increased, it might be due to examples such as higher office or office staff costs. So you'd want to recommend to the business to review these expenses and trying to cut unnecessary costs where they could, such as excessive office supplies or overtime to bring administrative expenses down and improve profitability. So up next is finance costs. So this ratio measures the percentage of sales used to cover finance-related expenses. The formula is finance costs divided by sales times 100. So just another quick example, if the finance costs were 5,000 and the sales were 500,000, the percentage would be 1%. If finance costs increase, it would most likely indicate more borrowing, so more interest that you'd be paying, because that's what finance costs are, so they're interest, or potentially an increase in interest rates, which would increase the interest payments for a company. What you'd want to advise the business to do to bring this down is to pay off their debts so they didn't have to pay interest on them, or to maybe try renegotiate loan terms for a lower interest rate. And then up next we have distribution cost percentage. So this is very similar to administrative and finance costs. So this ratio measures the percentage of sales used to cover distribution related expenses. So that's stuff that you're using to distribute your goods to people. So it could be wages of people maybe working in a shop, or maybe electricity in your shop, stuff like that you're using to distribute the good to the consumers. So just a quick example of this would be if distribution costs are $10,000 and sales of $500,000, the percentage would be 2%. If distribution costs increase, it may indicate an increased cost of delivering the good. Could be examples of that could be maybe an increase in gas prices or an increase in wages. To decrease the distribution costs, you'd need to switch to cheaper alternatives. So like before, like with administrative expenses, you'd be seeing where you could cut costs. Maybe switching to electric would cut down on gas prices, for example. And then finally, meaning of total expense percentage. So this here is the combination of administrative, finance, and distribution expenses. So if, just for an example, the formula is total expenses divided by sales times by 100. So if your total expenses were $100,000 and your sales were $200,000, then your total expense percentage would be 50%. So yeah, we'll move on to section 2 now, which is kind of looking a bit more at liquidity. So we'll start off with the current ratio. So to understand the current ratio, what we first kind of need to do is understand current assets and current liabilities. So a current asset is a short-term resource that a company expects to convert into cash, sell, or use within one full year. And then likewise, the same goes for a current liability. So a current liability is a company's short-term financial obligation that is due for payment within 1 year. The current ratio shows how effective the business is going to be able to repay their debts, their debts as they fall due. So if your current assets were, for example, $450,000 and current liabilities are $100,000, the ratio would be 4.5 to 1. So all businesses, companies, they want the ratio to be above 1 to 1. Otherwise, the business may not be able to repay their debts as they fall due, and they'd want it to be below 5 to 1 so that they're properly utilizing their assets and they don't just, for example, have cash sitting in the bank, which would be a current asset, not being properly utilized, not using their working capital. So to increase current assets, the owner doesn't have a lot of decisions, but the two things that they can do is they can invest more of their own money into the business, or they could go and get a long-term loan. And now, a long-term loan wouldn't affect their current liabilities because it would be a non-current liability. But it would still be a problem for the business in the future. So that's something you'd want to keep an eye on and be careful when suggesting that. So moving on to the liquid ratio. The liquid ratio is very similar to the current ratio, but instead of 1 year for the current ratio, the liquid ratio is for immediate debts, which is those that will fall due in the next 4 to 6 weeks. This does exclude inventory, just because that kind of messes with it a little bit. So the formula for this is current assets minus inventory plus prepayments, or current liability divided by current liabilities minus secured overdraft. Just a little change with that formula, so it is 4 to 6 weeks, so it doesn't include all your current assets and current liabilities. So an example for this one would be if your liquid assets are maybe 51,000 and current liabilities are 100,000, the ratio is 0.51 to 1. This shows that the company is in a bit of a dangerous position, as they're going to struggle to meet their immediate debts. So you really want this ratio, like the current ratio, to be above 1 to 1. Otherwise, the business may not be able to repay their debts as they fall due, and you want it to be below 3 to 1 so that they're properly utilizing their assets. So like current assets, to help solve issues around liquidity, the liquidity ratio, you may want to look at the owner investing more of their own money into the business or in the business to get a long-term loan. So now we'll switch forward to next slide. So the next one we'll look at is inventory turnover. So this one is another one that's quite reasonably straightforward. So the formula for this one is cost of goods sold divided by average inventory equals how many times the inventory is turning over each year. So an example of this would be if the cost of goods sold was, say, 318,000 and average inventory was 45,400, the turnover would be 7 times per year. So for your exams, if turnover improves, explain it might be due to successful sales promotions or better inventory management. Those would be some reasons for the trend, and you'd want to recommend keeping an optimal inventory level and keeping your cost of goods high, which you do by selling more goods. So you'd want to focus on your marketing and making sure you have a high customer satisfaction so that they're buying more of your goods and you've got a higher inventory turnover, which is good for a business. Just one thing to note on inventory turnover, it depends on the business what a good inventory turnover is. So if you looked at maybe a jewelry shop, they'd have a much lower inventory turnover compared to that of, say, a supermarket like Countdown or New World, which would have a very high inventory turnover. So it's hard to give an exact figure for an inventory turnover that's good. But for most businesses, you'd kind of want it at least kind of 6 to 10 at least. Okay, well, moving on. So next one we'll look at is age of accounts receivable. So this shows how long it's taking customers to pay back their debts to the business. So to calculate this, it is the average accounts receivable divided by credit sales times by 1.15 times by 365. So if the accounts receivable, which is the money that's you'll be receiving, money owed to you, was 50,000 and credit sales are 200,000. So credit sales are sales on credit. So the customer isn't paying with cash, they're paying and they're agreeing that they're going to pay you back in the future. And if credit sales were 200,000, the age of accounts receivable would be 91.25 days. So in exams, in your exam, you're going to want to discuss issues like delayed payments affecting cash flow and the problems that arise from that. And you'd want to bring the age of accounts receivable down, which is ultimately better for the business. You'd want to talk about maybe early payment discounts or stricter credit policies to reduce collection times. Moving on, we'll have a look at the rate of return on equity. So what that means, the rate of return on equity, it sounds a bit like a big thing, but it's actually not too complicated. So the rate of return on equity measures the profitability of a business based on a shareholder's investment. So what does that kind of mean? So we'll get into that, but just quickly first, the formula the formula is profit for the year divided by average equity times by 100. So if a shareholder or owner of the business puts money into the business, they're ultimately expecting most of the time to get money back. So the rate of return on equity is just looking at the money that they put in and the profit that they've gotten out of that. So if the net profit was $39,300 and the equity in the business was $355,000, the rate of return on equity would be 11.1%, which is a semi decent rate of return on equity. So in exams, you'd want to kind of discuss that compared to other investments. So for example, at a bank, which is a very low risk, you'd maybe get a return around 2%. And then if you could look at maybe the S&P 500, you'd get a rate around 8%, which is a higher risk generally compared to a bank. You'd want to recommend reinvesting their profits into growth opportunities in the business to enhance this ratio further, and then again compare to alternatives. That one can take some time to wrap your head around, but once you get your head around it, you'll kind of start to understand it a bit more, and you'll see that it's not too bad. So then we also have the equity ratio. So this shows how much of the business is funded by the owners compared to how much is funded by debt. So the formula is equity divided by total assets. So if the equity was $355,000 and total assets of $500,000, the ratio would be 71%. If this improves, it suggests reduced reliance on debt, which is good. So generally speaking, you wouldn't want your ratio to be higher than 0.5 to 1 or 50%, because that's starting to show that the bank may become less keen to give you any further funds, and just a higher risk in terms of taking out those loans, and you'd want to look at the owner investing more money into the business. So for your recommendations, you'd want to advise just to do what you can to reduce your loans and putting money into the business instead, reinvesting profits into the business, stuff like that. Yep. Okay, moving on again to the rate of return on total assets. So this measures how effectively the business's assets are generating profits. So that sounds a bit complicated, but again, once you wrap your head around it, you'll see that it's actually not too bad. So the formula for this is profit for the year plus interest divided by average total assets times by 100. So just an example for that would be if the net profit was $39,300 and the average total assets of $500,000, the return is 7.86%. So in your exams, you'd want to talk about how effective this is. 7.86% it's not awful, but it could definitely be a lot better. You'd want to look if it was kind of a very low number in your exam, like maybe 2 or 3%. You'd want to talk about how they're kind of underutilizing their assets and they're not being optimized correctly, and the business would want to start focusing on more high performing assets to enhance their returns, stuff like that. Okay, moving on to the last one, I think. So meaning of percentage change. So this one is pretty straightforward, just good to include in case it does come up. So it's just comparing two figures, so one from maybe a previous year to this year. It's pretty straightforward. Very rarely comes up in exams, but still good to know. So it's just this year's figure minus last year's figure divided by last year's figure times by 100. And just on the touch on on the kind of topic of calculating. In most exams, they won't ask you to calculate. They'll just look at you explaining trends, giving recommendations, and stuff like that. It's still good to have a bit of practice with calculation in case they do kind of throw a curveball and get you guys to do that. But over the past, I think 5 years, they haven't asked you, so just something you should know before going in. Okay, guys, so that kind of wraps up this video. Thank you very much for watching and listening. Definitely make sure that you've taken some notes, because they'll definitely help this kind of go into your memory a bit more. So now that you guys kind of have an understanding of the basics of Accounting 2.4 and the different financial concepts, you're going to be in a really good position to start having a look at some practice tests, some past papers and stuff like that. I'd really recommend going through some of my exam walkthrough videos for 2.4 and other standards, which are going to be published. If they're not already published, will be published soon. So in those videos, I'll take a look in the Accounting 2.4 video. I'll take a look through the exam and kind of apply the stuff from this video to that, and looking at how to get achieved merit and excellence. So yeah, that's a wrap. Hope you guys enjoyed the video, and have a good rest of your day.